Welcome to Every Dollar Counts with Josh and Jay, a shot of true serum for your investment and insurance questions. I'm Josh Knoll, the owner of Gulf Coast Financial Advisors, and I'm joined by my co-host, Mr. Jay Stubbs, the director of the Gulf Coast for First Protective. We are brought to you on the Gulf Coast Financial Advisors Podcast Network. Well, folks, you are joining us, Jay and I, today for a risk management two-pack where we're going to discuss a topic that has played into our multiple episodes we recorded in 2020, Jay, COVID-19.
Yes.
Wasn't necessarily in every single episode. You know, we have topics that are, you know, a little bit more timeless, if you will, but it definitely was an underlying current to much of the conversation we had. What we're going to talk about today is saying something that I know in my practice has been asked multiple times. I know particularly in your role, serving advisors like me, has been asked multiple times, the impact of COVID-19. What has it had on risk management industries, particularly specific to life insurance, long-term care, and disability income protection? So, you know, this topic obviously became significant as we navigated 2020. 2021, here it is. It's towards the end of January. It looks like this thing's going to be with us for a little bit while longer.
Agreed.
Right. And then also, folks, stick around as we go through the COVID conversation. We're also got a little added bonus. Jay's going to give his opinion on the 5 most common life insurance mistakes and how to avoid them. So with all that said, let's go ahead and jump in to our topic. Before we dive in, though, let's have our friends from Sloth Racer kick us off. All right, Jay, how you doing today, bud?
Josh, I'm doing well. It's good to be back in studio, first time for 2021 after a number of virtual studio visits as well as in-person studio visits last year. You know, certainly had great episodes with Will Stye and some of your colleagues from Prime Capital, but definitely one of the highlights is to get back in here with Johnny and Jed and be live and in person with you all here, yep. But also the chance to put out some good content as we get into 2021 and start thinking about some of our overall financial objectives.
Yep, absolutely. For those of you all watching us live, if you're wondering where we're coming from, we were recording in the studios, Deep Fried Studios here in downtown Mobile. Johnny Gwynn's our producer, does a fantastic job. Jay, I got a quick housekeeping for compliance before we jump into our topic. Jay Stubbs and First Protective are not affiliated with Prime Capital Investment Advisors or Qualified Plan Advisors or Gulf Coast Financial Advisors. And me, Josh Knoll, is not affiliated with First Protective.
But we're really good buddies.
But we're all really good buddies.
And we do business together.
Yes, we do.
That's right.
All right. So, Jay, let's jump into our main topic. Obviously, COVID has been a global pandemic. It's had significant impact on multiple parts of the economy, of people's lives. It's ever-reaching in the things that it has changed, potentially some things that it's changed permanently forever. But what we're going to focus on, because this is what we do for a living, this is how we help people, or one of the ways we help people, is we're going to talk about how COVID has impacted or changed the life insurance, disability income, and long-term care underwriting process, because it obviously has made an impact, and it's a question we're getting more and more. So I'm going to go ahead and turn it over to you, and let's dive into what people need to know about COVID as they're looking at these insurance products, especially, you know, let's even say, well, maybe they've had COVID. Maybe they're dealing with it.
Yeah. So, you know, right now we're in the middle of everybody going and grabbing the vaccine, whether that is in specific age groups or frontline healthcare workers. We're certainly and everybody's been hearing that in the news and the vaccine counts. So we're putting a little timestamp on that. And that's all going on right now with the different vaccines that are out there and available. Seems to be that is a little bit of a challenge. But also the challenge that's been thrown in is if you are in the market for a new life insurance policy or something to replace or add to your existing plan, or you're in the market for a disability income protection policy, which is protecting your household income and making sure you can pay the bills if you become disabled for an extended period of time. Or if you're in a retirement or nearing retirement and you're looking for a plan to install for a long-term care solution during your retirement years, have a plan in place to take care of that risk should it come up. All of those things require underwriting. Underwriting is where an insurance company in any of those 3 lines of business I just mentioned, they want to know who is the person we're looking at here, this insured, and what is their health status. And in the past, Pre-COVID, you would do what's called a paramed exam. You do some blood work. You do a little bit of fluid from your body, and you give them that access, and you'd answer a whole bunch of medical questions in addition to your height and weight and your blood pressure check, just an overall pre-screen to make sure what you've got going on is going to be a good fit for that insurance company, whether it's a life policy or a disability income policy or a long-term care policy. Well, when the pandemic comes in and COVID-19 throws us all for a loop, all of these companies are now like, whoa, hold on just a minute.
Right.
We need to assess our processes. We need to assess our underwriting manuals. And we need to really kind of grasp what is this thing just brought into our world, brought into our country, and brought into our business. How's that going to impact us issuing a policy? So yes, it's made some significant changes in 3 specific areas, and I'll let you kind of tell me which ones you want to hear first. So the 3 areas that I am very familiar with, having served in this industry for 22 years, significant impacts on underwriting. The changes in underwriting are now clear as mud. All the different companies we do business with, there's a lot of changes in underwriting. We can discuss that. Also, processing the business. When we are saying, hey, I'm ready to do this, what's the process that I can now implement? Well, I might not want to meet with somebody in person. I may want to meet with them over the phone or maybe through an online application process. And then also realize that that requires supports people behind the scenes. And those people are working remotely, more than likely, at least until the late spring or summer months. How does that impact the processing of the business? And then third, the demand. People have realized, hey, this thing's pretty serious. We want to make sure that all our I's are dotted and T's are crossed for our risk management plan. So a lot of demand has crept into the risk management world. They want their policies to protect themselves, their families, the income, the long-term care situation, and inclusive of their businesses.
Well, all right. So let me ask you a pretty hyper-specific question then, Jay, because I can almost guarantee you that someone is either watching this video or is listening to this podcast after we put it out on our different platforms and is in a position where they've dealt with COVID personally. They've had it, right? And more likely than not, it was potentially a life-changing event, particularly if it hit them pretty hard, right?
Right.
So now it's front of mind. Hey, I came into this thing, my world completely changed over the last year. And let's say I've got a family, I've got a spouse, I've got children, I've got a job, I've got things like that. I got people to depend on me, on my financial ability to provide for them. And out of the blue, I dealt with this thing. Now I need to look at, hey man, really need to look at life insurance, maybe more life insurance, maybe something to cover my income in case I get sick again. But do I qualify?
The answer to the question is yes.
Okay.
But there's some more subset questions that an insurance company is going to want to know. So what we call that is recovery. If you have been diagnosed with COVID-19 and you simply stayed at home in quarantine and used your whatever the doctor said to take, there's all different theories out there of what you were to take from a homeopathic standpoint. What are the natural supplements we need to have, whether that's B and vitamin D and zinc and all of that kind of stuff. Or you happen to have a need for any of the expectorants or the congestion, you need to fix all that. Well, okay. You stayed at home, you were healthy, you never really had to go to the hospital or do anything. You are insurable 30 days out from your diagnosis of positive test. You are insurable 30 days out from your positive test of COVID-19.
All right, so you mentioned
that's assuming you didn't have to be hospitalized. And if you went into the hospital, that's assuming that you didn't have to go on a ventilator. So those 2 specific areas, those are different timeframes. So we're first and foremost out of the gate, if you were diagnosed with COVID, you're 30 days out from recovery, you are insurable for insurance coverage.
All right. Well, you may not know the answer here, but let's say that otherwise relatively healthy person, let's take those 2 parts then, Jay, was hospitalized. Is it going to be, are they automatically disqualified from life insurance? Okay.
No, they're not automatically disqualified. All the companies that we do business with, and that's a good 24, they're going to ask that question if we say, yeah, I had to go to the hospital. That was a little challenge. I had to go and make sure that I was being well cared for. Maybe they were in a rural environment and they need to come into a metropolitan area, or maybe they just didn't have the people at home to help them take care of themselves, and they needed to go into a facility to do that, which would be the hospital. If you were hospitalized, the general rule of thumb is 30. There's 1 or 2 companies that say, hey, if you're hospitalized but you're back at home, we're still at 30 days. There's several other companies that are at 60, several other companies at 90, and even a couple of companies are all the way out to 180 days. So really it is specific to the companies we're looking at for your product or your solution, but it could be anywhere from 30 to 180 days out before you would be considered insurable. And what we call in our industry is that we're going to postpone you. Josh, we're just going to postpone for 30 days till we make sure everything's free and clear and we're out of the woods.
Very good.
Some companies 60, other companies longer periods of time.
Jay, so for those of you all that are watching or hearing this later and hearing Jay mention several different companies with several different requirements and maybe not familiar with his role or how he works with me at my practice, what Jay's referring to is he represents a network of companies through First Protective. He's got different carriers, many name brand. He could sit here and list them off and you would have heard of all of them, that he is able to go to them, to these different companies, and really look for the most competitive option for somebody's particular situation. Now, historically, Jay, that means that we'd have somebody come in that's a occasional cigar smoker, or we'd have somebody come in that maybe had some height and weight issues. You would know which carrier or carriers would be the most competitive for that situation. What we have now is we have a unique element added at with COVID, but you're still going to have the ability as these carriers start getting settled in on what this means long term to look at someone's age, look at the situation they went through, look at their other health history, and should be able to point them at least to the right carrier or carriers that fit that person's situation the best, right?
So the first question that will come out, in addition to some other field underwriting questions, will be, have you been diagnosed with COVID? When? How long ago? That kind of thing. The next one was, if you haven't been diagnosed, were you exposed? Exposure means somebody in my household had it. I never was tested positive. I didn't have any symptoms. That is another 30-day window. So you might say, hey, I was exposed. Am I still insurable? Yeah, you're still insurable. You just got to have a 30-day wait time before or after your exposure.
Very good. And Jay, as we're wrapping up that conversation, let's look at the other side of that coin. Somebody that was blessed, you and I have been blessed through this. We've been able to stay healthy. I wonder if the insurance companies have accommodated for the fact somebody that has made it through and has received the vaccine. Is that going to help their situation? Does it matter? Has there been a conversation about that?
Yes. So I've got a case right now that we're working on with as a physician. He's getting more coverage to protect his family. And he had specific questions around, okay, I've had the vaccine, actually both doses of the vaccine.
Right.
The insurance companies love that, the fact that you've had both vaccines and the fact that he is in the medical field. They know that they're social distancing. They know that they're doing everything practical to stay clean and avoid exposure in the medical practitioner. So he's still possibly a preferred best risk because of his vaccine and the field that he's in.
Perfect.
So if you've been exposed, had the vaccine, that puts you in a better light at the insurance company. If you're in recovery and you're past that time frame and you got the vaccine, then you're in a better light as well, as long as your time frame has elapsed before you do the paperwork and send it in.
And Jay, I want to wrap up the main part of our conversation with this last question to you, segueing just a little bit here. We're talking about the three main types of risk management policies: life insurance, disability income, and long-term care. However, those three policies are not necessarily underwritten the exact same way. Would you mind to just briefly touch on kind of the difference between mortality risk and morbidity risk?
Yep. So life insurance is definitely mortality risk. They use the life expectancy tables that are put out every few years. Those are called CSO tables. I don't want to bore you with all the details, but that's the mortality risk. So life insurance looks at some mortality rates. That's based on male, female, based on date of birth, how old you are. It's based on smoker, non-smoker. If you use a tobacco product, whether it's smoke or smokeless tobacco, and then it's also based on some of the field underwriting questions that we just discussed. Whereas disability income protection policies, as well as long-term care protection policies, those are based on morbidity. Think about the body. How is your body reacting to certain things, but not taking death into consideration? Because both of those are paying a benefit while you're alive.
Right.
Disability pays a benefit should you become disabled and can't do your primary function at your job. Long-term care pays a benefit if you can't do 2 of 6 activities of daily living. Those are the two policies, and those underwriting processes are morbidity processes. Yep. Life insurance is mortality.
Very good. And for those of you all, is particularly in Jay and I's line of work, we do deal with, he mentioned physicians earlier with disability income. They have a particular set of needs with their hands, mental acuity, things like that. And then last thing on that, Jay, is also too, if you all are out there and you're looking at something, disability income or long-term care, and let's say you're like me and, my knee fell off my leg about 2 years ago, right? So you would look at that and you say, "Oh my gosh, there's no insurance company is going to underwrite me. I'll be in a walker when I get to my older years because of this knee." But understand this, that they can exclude certain parts of the body.
That's right.
Yeah, they can even exclude certain parts of the back.
That's right.
Depending on where you're having the issue at, right?
That's right.
So don't think that, just because you have one particular issue, maybe you can't get coverage for that one joint or that one piece, but you have other options. So, well, Jay, then I want to go ahead and, while we're on this topic of life insurance, I want to go ahead and segue to, again, your line of work, you serve advisors like me with their risk management needs, their financial planning needs all along the Gulf Coast here. And then, of course, in my practice, particularly that I came up on the insurance side, going on 12 years now, we both have handled a lot of policies. I mean, hundreds, thousands in your case, probably.
Yes, it's thousands, definitely.
Yep. So of those, what is the 5 most common life insurance mistakes that you see, and what's a couple tidbits for someone how to avoid them?
So I'll just rattle the 5 off, and then we'll dive in, not weeds, but we'll get a little bit more in depth on the 5. And this is based on my experience and my opinion, having served in this risk management community in Mobile, Baldwin County, but serving my company for now 22 years. The first is the beneficiary issues, meaning, okay, I have a life policy. I have to designate a primary beneficiary who's going to receive the proceeds from this policy. I see a lot of improper beneficiaries, whether that's a minor situation. So I put my children as a beneficiary. I've got 4 of them, all of them under the age of 18. Should I pass away and they're the beneficiary, they don't get access to those funds. It's whoever the caretaker is of that minor, whoever the guardian is of that minor. So it's okay to do that because Casey, my wife, would be the guardian of my 4 kids. So I could technically name them as beneficiaries, but sometimes that throws it into a kink if there's nobody that's named as a guardian. That goes back to as a kind of a will and a plan there for what's going to be the guardian for your minor kids. So I see some improper things in beneficiary designations for minor kids.
And people forget to take the X's.
That's right.
Off.
Yeah, sometimes that happens. That comes into the review. So the other thing under beneficiary is they'll name their estate as the beneficiary of the policy and just say, let my will dictate where the money goes after that. Well, that means anything that you name to your estate is going to have to go through probate.
Right.
Doesn't mean that it's not a good setup. A lot of people use the estate of Jay Stubbs or the estate of Josh Knoll as their contingent beneficiary if their primary is not around when you die.
Right.
But oftentimes that we don't see anybody with a contingent beneficiary.
Right.
So if I just named my wife as the primary beneficiary without contingent and we happen to pass away in a car wreck together, then it's going to go through will and probate because I didn't name a contingent. In that instance, I could name a contingent as all 4 kids.
Okay.
And then whoever the guardian is of my 4 kids, should my wife and I predecease them, then the guardian will have access to the funds to care for those children.
Right.
And you can make those changes as your kids get older, changing them from contingent to primary if you want to. So that's the first one, beneficiary issues. Product solution doesn't match the problem at hand.
Okay. What do you mean?
That means perhaps I bought a product that I was told that it was the good fit for me, but it doesn't cover the entire financial need. I see this often. I'm not picking on anybody whatsoever, but they say, hey, I'm going to go get life insurance, and they buy a $50,000 or $100,000 whole life contract and think that that's going to be good for their family, when indeed it's not. It's not enough coverage if they do a needs analysis, or perhaps could not be enough. So if they understand the importance of whole life's good, it's a good fit for you, but you need to complement that with maybe another policy or another term. Or maybe they buy a term policy, but they don't buy a long enough term period. Or maybe they buy a cash accumulation policy, which they don't have any interest in cash accumulation. They just want a death benefit. So I see, basically the solution that they currently have, they may have gotten it from somebody online or through an 800 number. That's areas where you and I
we have some fun with that.
We have some fun with that. Or they bought it from somebody and it was all good intentions 5, 6, 7 years ago. But things have changed.
Life has changed.
Yeah, and so it might not be a good fit today. So I see product solutions currently owned don't match the problem within the household or within the business. The next is, and this kind of dovetails in, there's failure to review the policies. You want to review anything insurance related every 2 to 3 years. It's just part of the plan to do an annual review. We review our statements. If you had my retirement plan, you're reviewing that every year.
Right.
I'm getting a quarterly statement. We're maybe having a conversation about that. But in life insurance world, disability income protection world, long-term care, we want to do an annual review a review of that every 2 to 3 years.
Right.
The next common life insurance mistake is the coverage amount is inadequate.
Yeah, kind of back to where you were talking earlier. There's multiple formulas a person can use to determine their amount. I mean, really, the probably the most accurate way is go ahead and work with somebody and go through a financial plan.
A financial plan, or at a minimum, a needs analysis.
Right.
Hey, put pencil to paper. What's our debt? What's our income that needs to be replaced? What other things that we want to set aside, whether it's college education funding, what have you, funeral expenses. Let's get a number that we can figure out based on our needs analysis, and we can decide this is a good fit. Oftentimes, we'll ask people to fill that needs analysis out, and they're surprised, hey, I didn't get enough coverage. I thought I needed X, and I really needed X plus. Oftentimes, people say, I bought based on a needs analysis, and I bought too much. Just want to make sure you have the right amount of coverage for your plan that fits your family, your lifestyle, and your business. And then the last common mistake is the ownership. Certain people, certain segments of wealth, they definitely want to consider ownership of a life insurance policy outside of their estate. And that means they need to own it in a life insurance trust. An irrevocable life insurance trust specifically will get a life policy outside of the estate, and you can have that trust designed so that it does exactly what you want it to when the proceeds are paid into the trust. Ownership also comes into issues when you switch ownership. Maybe a husband and wife say, I have a policy and my wife, Casey, owns that policy on me, and then I own a policy on her. Well, this will never happen, but say, for instance, she just doesn't want to deal with me anymore and we end up getting a divorce. That throws a complete wrinkle in the policyholder service, because that means the proceeds that I have on my life are controlled by somebody who I'm no longer married to,
right,
and vice versa. That can present some family challenges and some decision-making challenges for that family.
Very good. All right, so listeners, let's quickly recap what we learned today. Our main topic was COVID and how it's impacted life insurance, long-term care, and disability income underwriting. As you heard Jay lay out, there's companies with 30-day look-back, especially if you haven't been hospitalized. If you have been hospitalized, it doesn't necessarily mean that you're out of the equation, or that even that you've had COVID. Doesn't mean that you're disqualified by any measure. Every situation is going to be unique, and life insurance carriers have started to accommodate the reality of what's going on in the world with this impacting so many people. We also talked about the 5 most common life insurance mistakes that Jay and I see: beneficiary issues, product solution doesn't match the problem, failure to review, coverage amount inadequate, and policy ownership. Now, those 5 things, those are big things. And what I would say to everybody is, at its root, life insurance is not complicated. Life insurance is something, or even disability income, these are not complicated things. If you die prematurely or you are disabled through illness or accident, how do you financially replace your ability to produce income? Well, that's the root of it. So don't let these things overwhelm you. Get in there, do a quick needs analysis. You can get insurance in place. And then these things that we talked about, it's really just, more often than not, Jay, you're talking about the largest single sum of money that most people will receive when they receive the proceeds from a life insurance benefit, right? So looking at it every couple of years and making sure it's buttoned up, you're talking about your time spent for the potential value of the proceeds is pretty high. It's worth the time.
It's worth the time to sit down with a professional like yourself and review what you have or where there might be gaps. Because ultimately, at the end of the day, you want if you have the mindset of, I want to make sure that my family's protected, my kids are protected. If you're a grandparent, you want to make sure your grandchildren might be protected. There's all kinds of reasons. Get it. People come in and ask questions about life insurance, but really and truly, it's to protect the people and the things that we love, and to make sure that those things can continue on without burden or financial distress should we predecease them.
Very well said, buddy. All right, so listeners, if this topic applies to you, we can help. You can reach out to us to start the conversation. Call us at 251-327-2124. You can leave a message, or you can visit gulfcoastfa.com. That's FA as in financial advisor. And while you're there, you can actually set an appointment on my Calendly app if you would like. Plus, you can dive into all the great content and details that we have on that website. Also, if you're interested, if you're an independent or semi-independent agent or advisor and you're listening to this and you're interested in the value and the knowledge that Jay Stubbs could bring to your practice, You can find more about him at jstubbs.com. That's JAYSTUBBS.com. All right, Jay, so another show in the can. Yay, good job. We were, for y'all, our live video closed up. If you all could see us right now, we've got computers, we've got screens, I feel like a movie star.
You don't look like one. I know. You might feel like one, Josh, but you certainly, neither do I for that matter.
I feel like a Ron Burgundy. I'm kind of a big deal around here. So many thanks to our producer, Johnny Gwynn, Deep Fried Studios. Many thanks to my co-host, Jay Stubbs. And as always, a huge shout out to all of you that have joined Jay and I on this journey. And to those of you that are joining us now, do me a favor, please subscribe on the Apple Podcast app or wherever you find your favorite podcasts. And while you're there, you would be doing us a huge favor if you would rate and review the show. It helps other listeners like you find us. Lastly, you like the show music? Go check out slothracerband.com. That's slothracerband.com. And they're going to take us home now. This has been Every Dollar Counts with Josh and Jay. Advisory services offered through Prime Capital Investment Advisors, LLC, PCIA, a federally registered investment advisor. PCIA, doing business as Prime Capital Wealth Management, PCWM, and Qualified Plan Advisors, QPA. Gulf Coast Financial Advisors is independent of Prime Capital Advisors. Information presented is for educational purposes only, is not an offer or solicitation for the sale or purchase of any securities. All investments involve risk, and unless otherwise stated, be sure to consult a tax professional before implementing any tax or investment strategies.